Coming up on Market to Market. Pipeline protests push the stop button on construction. Oklahoma shakes and injection wells take some of the pressure. And the prospects for new mineral resources in the land of 10,000 lakes. Those stories and market analysis with Ted Seifried next.
Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com. This is the Friday, September 9 edition of Market to Market, the weekly journal of rural America.
Hello, I'm Mike Pearson. Autumn is a scant 2 weeks away, but farmers have already begun the annual rite of fall. Harvest is picking up as the price of powering the tools of the trade declines. Just 3 years ago, oil tipped the scales at $107 per barrel. However, increased output has the commodity clawing at the $50 mark. Over the same 3 years, AAA figures show the price of a gallon of gas has fallen 37%. According to the Purdue University CME Ag Economy Barometer, falling commodity prices and the potential for increased input costs has pushed the index lower. Wall Street put most of its efforts into dealing with rumors of a potential interest rate hike. The result was a 319-point loss for the week. Policy surrounding energy has gotten traction in the halls of Congress for the first time in nearly a decade. The slippery part of the equation is getting agreement among the nearly 50 members of the committee. As the details are hammered out in Washington, private interests like Energy Transfer Partners continue to work on jumping construction hurdles. The latest blockade curtailed work on their path for crude oil leaving the Peace Garden state. Peter Tubbs reports.
Protests in North Dakota halted construction of the controversial Dakota Access Pipeline this week, pending a federal judge's ruling. Hundreds of demonstrators have camped a short distance from the work site near Cannonball, North Dakota, since April. Protesters, mostly members of the Standing Rock tribe, who have lived in the Dakotas for centuries, claim the pipeline route traverses lands where ancestors are buried, and that the United States Army Corps of Engineers failed to do proper cultural and historical reviews during the approval process. A federal ruling from the D.C. District Court put a hold on a portion of the construction to study data submitted by the Standing Rock tribe. However, work continues on most of the 1,100-mile-long pipeline.
We're disappointed. We showed the judge evidence of sacred sites in the pipeline's route. We asked that construction be halted until those sites could be properly surveyed and dealt with, and he gave us a partial victory.
By the end of the week, the judge handed down a decision in favor of Dakota Access, allowing work in the contested area to resume. Protesters also are concerned about risks of the pipeline passing under the Missouri River. Pipeline breaks under other waterways have already caused billions of dollars in damages in the past 5 years. The $3.8 billion project had been approved by multiple state and federal agencies, and Dakota Access has negotiated easements with hundreds of private landowners along the 4-state route. Barring further legal action, the pipeline is expected to be completed by the end of the year. From Market to Market, I'm Peter Tubbs.
Late Friday, the Departments of Justice, Army, and Interior asked Energy Transfer Partners to voluntarily pause work near the disputed areas. As of the taping of this program, there has been no response from the company. Farther south, an earthquake that shook the ground from Illinois to Texas had its epicenter in Oklahoma. Physical damage was minor, but questions continue to be asked if human activity helped Mother Nature move terra firma. John Torpy reports.
This week, a major earthquake shook the Sooner State. Government officials looking for a source turned towards oil and gas production as the potential trigger. Centered in northeast Oklahoma, the 5.8 magnitude trembler could be felt across the Midwest. The geological event was the second earthquake reaching a magnitude 5 or higher in Oklahoma this year. Some officials worry the seismic shocks are a sign of stronger quakes to come. Since 2014, earthquakes in Oklahoma have been linked to wastewater disposal wells from petroleum production. Large volumes of toxic liquid are injected deep into the earth at high pressure after being extracted from oil and gas wells. Officials suspect wastewater is lubricating fault lines, leading to the tremors. In 2015, after cuts mandated by state regulators, the amount of injected wastewater decreased by roughly 25% from 2014 levels. Officials with the Oklahoma Geological Survey said the reduction in wastewater disposal appears to be producing the desired effect, dropping the number of quakes 3.0 and larger from 907 in 2015 to 472 as of September 4th of this year. The Oklahoma Corporation Commission, the state government body charged with regulating the oil and gas industry, ordered 37 wells near the epicenter of this week's earthquake to be shut down because of previous connections between injection wells and earthquakes. The Environmental Protection Agency shuttered an additional 17 wells located on the Osage Nation reservation. Oklahoma regulators have no jurisdiction over oil and gas producing facilities on tribal lands. Aftershocks continued throughout the week as magnitude 4.1 and 3.6 quakes rattled the northwest quadrant of the state. For Market to Market, I'm John Torpy.
Making a phone call from the field or pulling down GPS coordinates to apply just the right amount of fertilizer is commonplace. The need for this digital interface has ramped up the search for raw materials to manufacture the next generation of powerful electronic tools. However, some wonder if the costs outweigh the returns. Josh Bittner found a case in point where communities in northeastern Minnesota are wrestling with how to balance the possibilities of economic growth and the potential pitfalls of environmental damage.
Each year, outdoor enthusiasts flock to Minnesota, partaking in the state's abundant recreational activities. And while tourism brings billions of dollars to the land of 10,000 lakes, the state's economic backbone stems from farming, logging, and mining. Together, these industries play a significant role in Minnesota's fiscal makeup. However, in the search for more minerals to power industry and fulfill consumer demand for electronic products, Minnesota mining companies are looking for new ways to pull profits out of the earth. Proponents say new sulfide operations will unlock highly lucrative precious metals. And the prospect of added jobs is welcomed by many in a region sapped by an economic slump.
In every area that is water-rich, like Minnesota is.
But environmental lawyer Paula Maccabee asserts potential side effects to northern Minnesota's pristine natural playground should render such projects dead in the water.
Traditionally, Minnesota has done iron or taconite mining, but copper-nickel mining is different because the geology is different. The copper and nickel are bound to sulfur-bearing rock, and when that rock is pulverized and exposed to water and air, it creates acids and even acid mine drainage.
Since 2008, applications to conduct exploratory drilling of the Duluth Complex, a vast mineral deposit in the Arrowhead of Minnesota, have surged. According to some estimates, the 4 billion tons of copper, nickel, platinum, palladium, and gold in the ground could be worth up to $1 trillion, though value relies heavily on volatile commodity prices following excavation. Geologists have known about the formation for over 60 years. Companies like Polymet Mining Corporation claim advanced flotation and hydrometallurgical processes, along with better water treatment technology, make their venture both cost-effective and safer than ever before.
It's been proven that we can meet water quality standards, both surface and groundwater, here at the site. If we can't show that through environmental review and permitting, we won't get a permit to operate.
It's crazy to clean the river only to allow it to be polluted again.
Some area taxpayers fear a relapse of past iron ore pollution wrought by legacy mining before the adoption of modern safeguards. Demonstrators maintain PolyMet's NorthMet site also would threaten the health of the local St. Louis River watershed. Native Americans exercise their legal right to hunt, fish, and harvest wild rice in and around the region's open waters. A broad coalition of tribal entities, concerned citizens, and public health officials have warned of sulfide mining risks. The Port of Duluth straddles the St. Louis River and Lake Superior. Several commodities flow through North America's furthest inland port, in particular taconite. Extraction of the steel-making material has declined for years, but shuttered mining facilities may provide an opportunity to repurpose abandoned infrastructure. PolyMet's surface mine operation is the first to undergo a decade-long federal and state approval process. And Minnesota state law requires a financial guarantee at the time of permitting to protect taxpayers from closure and reclamation costs. Despite having to traverse the legal landscape, other corporations have thrown their hats into the ring.
Twin Metals Minnesota is a company that is solely focused on developing an underground copper and nickel mining project in northeastern Minnesota. We were created in 2010 as a joint venture between a company from Canada, Duluth Metals, and an international mining company, Antofagasta Minerals, out of Santiago, Chile. We are now a wholly owned subsidiary of Antofagasta Minerals.
Early this year, Minnesota Governor Mark Dayton denied Twin Metals access to state land for environmental study work, citing grave concerns that copper-nickel mining would endanger the state's Boundary Waters Canoe Area wilderness. Twin Metals officials say the move failed to derail their efforts, and that Governor Dayton acknowledged a final decision rests with other government entities who are all involved in a complicated mix of land swaps and mineral leases. Twin Metals continues to ramp up for a projected 2018 environmental review. PolyMet appears to be in the final stretch of permitting and real estate decisions ahead of digging. Project backers say copper and nickel, chief components in cell phones, hybrid car batteries, solar panels, and wind turbines, are essential building blocks for a high-tech, clean energy future. But some say demand for certain minerals could be met by supply on hand.
What many people don't realize is that there is enough copper already dug out of the ground, and it retains almost 100% of its value.
PolyMet officials acknowledge one of the mineral's greatest qualities is its relative ease of reuse, but cite U.S. Geological Survey data from last year that recycled copper was equivalent to only 9% of apparent consumption. And currently, the U.S. is a net importer of the metal. While various financial sources forecast anything from a worldwide copper glut in the near term to strong medium and long-term growth, PolyMet and Twin Metals say they aim to forge independence from less climate-minded competitors like China, the world leader in copper production.
Demand for these minerals internationally is not going to subside. So do you want to mine these minerals in a country and in a state that have solid environmental standards, some among the most stringent in the world, good working conditions, child labor laws and the like? Do you want that done here, or do you want it done in a country that doesn't have those standards?
For Market to Market, I'm Josh Bittner.
Next, the Market to Market report.
Anticipation over next week's supply and demand report added a little fuel to the fire in the commodity markets. For the week, December wheat gained 4 cents, and the nearby corn contract moved 13 cents higher. There was plenty of volatility in the soy complex as the November soybean contract gained 28 cents. October meal climbed $8.20 per ton. In the softs, December cotton had its first week of gains in more than 2 months, adding $1.29 per hundredweight. Over in the dairy parlor, October Class 3 milk futures lost 29 cents. Prices in the livestock sector were mixed as the October cattle contract put on $2.80, October feeders shed 79 cents, and the October lean hog contract dropped $1.53. In the currency markets, the U.S. dollar index lost 51 points. Crude oil advanced $1.44 per barrel. Gold rose $7.80 per ounce, and the Goldman Sachs Commodity Index gained more than 14 points to finish the week at 361.20. Here now to lend us his insight on these and other trends is one of our regular market analysts, Ted Seifried. Ted, welcome back.
Hey, thanks for having me, Mike.
This is kind of an exciting week, Ted.
Yeah.
We've got some upward momentum in the wheat market.
What do you know?
I use that term loosely. We're 4 cents positive here in the nearby. Does this tell us that perhaps we've got a bottom finally established in wheat?
A higher week does not a bottom make necessarily. I think it would take a lot more time for something like that to happen or to comfortably say the bottom is in. The fundamentals for wheat have been so negative for so long. You do kind of wonder at what point do things stop getting worse and more negative. The concern that you have for the wheat market is that the funds are building a very large short position. I mean, massive, especially when you look at it from a percentage of open interest perspective. The good news there is, though, when and if, but really when these funds start to cover that short position, you can get a rally in wheat that defies gravity, defies anybody's belief of where we could go with wheat. I'm going to talk about corn and the same thing in corn, but 2014 corn in October 1st, from October 1st through December 31st, we rallied almost $1 on a record national average yield corn crop. That had a lot to do with funds getting out of a short position.
Okay.
Nobody understood it at the time, and that's a similar setup that we could have at some point for the wheat.
We just need something to change the narrative.
Yes.
Now, we do notice continued weakness in the dollar.
Yep.
Is that helping wheat at least maybe establish a bottom?
Theoretically, it should be.
Okay.
And this last week of export sales were actually better than expectations. They weren't outrageously good, not anything near what we've been seeing in corn and soybeans lately. But it was better than expectations, over 600,000 metric tons. That's a pretty good week for wheat compared to what we've been having. So maybe we are starting to see a little bit of that. But the week before that, export sales were poor, very, very poor. So we're going to need to see multiple weeks of these better export sales to say, hey, the lower dollar is helping, we're getting more competitive, we're starting to see this business happening here at this point. And again, that could start to change the narrative. But I think more likely with projections on this USDA report, I'm looking for a 1.084 billion bushel carryover for wheat.
Slight decrease from their August number.
Slight decrease from their August number. And better exports because of the Canadian numbers, by the way. But we're going to have a production issue somewhere.
Gotcha.
Because we've got global and domestic ending stocks that are large enough that we've got to take something out of the production. We're trying to do that by reducing acreage, but then we counter that with really very good yields. At some point, we'll do that. And I think that job is mostly done.
Okay.
But, when does that spark happen is the question. And I'm not sure this last week is the catalyst for that. It might be something that happens in row crops.
Okay. So let's talk about that. This corn market, we're anticipating a very large crop. Do you have an estimate for national average yield on Monday's report?
Yes, we do. We're at 173.4. And I laugh at that because that is exactly the average trade guess. I don't like when that happens.
All right. But that's not your final number. You're anticipating we'll see the USDA continue to ratchet down their national corn yield through the year. Where do you figure we'll end up come January?
I think we're a lot closer to the 170, maybe slightly below the 170 mark. That's what I'm seeing. You have to sort of compare this year to 2014 because that's the last time we set a record national average yield. Currently, the USDA is looking for us to set a new record national average yield by over 4 bushels an acre. I look at what we did in 14. I look at what I was seeing in 14, pictures and walking fields. I just don't see the same crop. We also are producing this crop on bigger acreage, not quite 4 million acres more. And usually when you up the acreage like that, it becomes harder to get to that national average yield. And again, in 14, I was seeing nothing but really very good corn, lots of multiple ear corn stalks. This year, you've got some very good looking corn, but you also have some corn that has had pollination issues. You've also had some corn that has some pretty significant tip-back, some disease issues, green snap.
I tell you, we're just getting into harvest. I was in north central Iowa this week from about Storm Lake over to Laverne, and flooded fields. They'd gotten 4 inches of rain earlier this week. That rain and that projected wet spell as we get into harvest, is that helping provide a little support to this corn market?
It is. I'd say soybeans maybe more so than corn because we're worried about disease issues in soybeans, although it might be a little early for that. But we remember what just happened in Argentina. I think that's supporting the corn market. I think the overall idea that the trade has, when we're actually seeing on paper average trade guesses of a yield coming down, and there too, fund to short covering has really been the highlight of the week. And these guys have a very large short position. If they're going to get out, it's going to give us upward mobility in the corn. Now, I would like to say that, while this week was impressive and warmer, fuzzier feelings this week than last week.
We bounced off 318 and a quarter.
Yes, a lot of people when we were down there were thinking, oh, we're going sub $3, which I don't know about that. But I also don't know if this is the harvest rally.
Okay.
It's very early for that. I mean, we put our lows in either August 31st or September 1st, depending on which row crop you're looking at. That is exceptionally early. I do wonder if there's going to be another pushback down towards lows. But what this week was a wonderful example of what happens when you get these funds in short covering mode. Because when they cover 20 to 25,000 contracts and we get a 20 to 25 cent move, that says something. Now, farmers will get exponentially more aggressive on sales if we start getting into the higher prices.
Yes.
So it's not going to be that similar to 1-to-1 ratio that we kind of saw this week. But if the the funds start to cover shorts, we can get a very nice rally despite a very large crop.
Okay, now we wanted to move on to the soybean conversation here. We've got a question from Dan in Grantville, Kansas. He's asking, come Monday, is a 50-plus bean number going to drag everything else down further?
A 50-plus bean number is a wonderful question. I guess that's a question for the USDA. But Dan, to your point, I think there are a lot of people out there that are starting to think in the 50s.
Okay.
For our official estimate for this report is 49.4. So we're moving a half a bushel higher than where the USDA previously was. By the way, what that does to my balance sheet is kind of interesting because lower beginning stocks, meaning old crop carryover, should be coming down, in my opinion. Lower beginning stocks does something to offset that higher production and then just slightly more export demand. I'm at a 339 million bushel carryover despite a half a bushel an acre increase.
Okay.
Which, in my opinion, that's still a relatively tight ending stock number considering the circumstances.
And considering just a year ago we were talking 500 million plus bushels.
Right.
And we have seen incredible export moves earlier this week.
Absolutely.
500,000 metric tons sold between China and unknown
sales
destination.
today were just under 2 million metric tons.
Jeez.
And we've seen multiple weeks like this in a row. So, but to your point, this time last year we were talking 500 plus million bushel carryover. This year we're at a 330, and this is going to be a record soybean crop, or at least by all indications right now. Record production, well, the last 3 years of global production have been the top 3 we've ever seen, yet you have declining global carryover in soybeans.
Demand is strong.
Demand is very, very strong, and production is increasing. We're increasing our yields, we're increasing our acreage, yet we're still seeing global ending stocks coming down. Demand is outpacing the increase in production. So if there were any sort of hiccup here or in South America, and we've got South American weather growing season coming up soon, any sort of issue there, we could have a problem. We could, then the question of what is pipeline beans nowadays, which I think is a lot closer to 200 million bushel than...
We have a little hiccup. Pop this higher, something to consider as we're figuring our spring planting mix.
Just the idea of weather premium that we build into the market on the South American growing season could be very friendly for soybeans.
Well, now let's jump into this cattle market, Ted Seifried. We saw a big spike down early in the week, end of last week, Tuesday of this week. Then we recovered. Cash is lower, but are we finally finding some value? We didn't hold that sub $100 level on the board. Are we safe saying we're not going below 100?
Well, a lot of volatility in cattle this week. And a lot of times when you get high volatility like that, and cattle's lately, last few years, have been very notorious for the volatility, but a lot of times when you get high volatility like that, near extremes, you can say that we're trying to at least carve out a little bit of a bottom. Big psychological support level there. But more than that, I think we really ran into a very key technical support area. If you look at a longer term chart, a downward trending channel, we ran into that downtrend line, which we've hit many times before, and we've had we've had nice bounces off of that. We've really respected that trend channel very well. And I think that had a lot to do with the bounce that we had, despite lower cash. I'm looking for a couple more positive days in cattle. I am hoping or optimistic that we are in the beginning processes of a longer-term bottoming formation.
All right. On the live cattle side, as we take a look at feeder cattle, how does your perception change as you look out to the future there?
A little bit different chart look to the feeder cattle, but you got to say that today's price activity was really very good. That reversal off the low, you make a new low, and then you end up closing right near the previous day's high. That's really what you want to see. That is a short-term friendly thing. We've seen things like this in cattle though recently, and we've negated them within a day or two after that. So stay tuned. But I would like to see. I would like to think that feeder cattle have upward mobility from where they're at, because I'd much rather see a feeder rally than a fat cattle led rally.
Okay.
But I think we're just a little bit behind on the chart. I think we need to see more work on the feeder cattle to really have a good feel on what we might do going forward.
All right. Well, taking a look over at the lean hog complex, we had some rumors, I don't know if anything was confirmed, of China buying, stepping back into the market. Have you heard anything to that effect?
As far as I know, that's just rumors to this point. But I've heard those rumors, and I've been talking about that all week. I think this is a very interesting setup for hogs right now, because China likes to play games with commodity markets. They've done that very successfully in many things, milk included, corn and DDGs actually as well, soybeans. They like to do that sort of thing. And a few weeks ago we had some cancellations from China on our pork exports. They were small, but the market really didn't like that, because the big hope for some time now has been that we'd see a big increase in Chinese interest in our
Do we need to see China jump back in to push this thing into the mid-60s?
I think we do. I mean, we need some sort of increase in demand to offset the supply. But when China comes in and cancels small shipments like that, sometimes that's them trying to push the prices lower to come in and make much bigger purchases.
So stay tuned as we watch this lean hog market into the future.
Absolutely.
We'll discuss this further in the Market Plus section. Thank you, Ted.
Always a pleasure, Mike.
That wraps up the broadcast portion of Market to Market, but Ted and I will keep the market conversation going, including answering more of your questions during Market Plus, which you can find on our website. And seek us out on Facebook. You'll find links to some of our videos, and you never know when we might go live for a behind-the-scenes report. And join us again next week when we will devote the entire program to the effects of that September supply and demand report with a roundtable discussion. So until then, thanks for watching. I'm Mike Pearson. Have a great week.
Market to Market is a production of Iowa Public Television, which is solely responsible for its content. Funding for Market to Market is provided by Grinnell Mutual. You think differently about a customer when you stand in the middle of his dreams. We work to make sure you get covered right. Grinnell Mutual, a policy of working together. Information on finding an agent near you is available at grinnellmutual.com.